Something fundamental broke in our global financial architecture during the first week of December 2025, and the silence from mainstream media has been deafening. While the general public was distracted by holiday retail figures and the usual year-end stock market optimism, a quiet catastrophe was unfolding within the high-security vaults of New York City. According to official exchange data, the Comex registered silver vaults witnessed a historic hemorrhage of physical metal. We are talking about 47.6 million ounces of silver vanishing in just 4 trading days. To put that into perspective, that is not a routine withdrawal or a minor adjustment in inventory. It represents nearly 60% of the entire registered silver inventory, the specific category of metal that is actually available to satisfy delivery on futures contracts. This sudden drain is a full-blown emergency for the mechanisms of price discovery. In the world of precious metals, there is a massive difference between eligible silver, which is metal stored in the vault but owned by private parties, and registered silver, which is the thin layer of liquidity that keeps the paper market functioning. When 60% of that liquid layer disappears in less than a week, the system is no longer just tight, it is running on empty. This collapse in inventory exceeded every major panic of the last 2 decades. It was larger than the silver peak of 2011, more violent than the Reddit-fueled silver squeeze of 2021, and more rapid than the inflation-driven rush of 2022. But the most disturbing part of this story is not just the volume of metal leaving the vaults, it is the identity of the players moving in the shadows. While retail investors were panic selling or standing on the sidelines, the largest commercial banks in the United States were doing something they have never done in the history of modern record-keeping. According to the December 2024 and early 2025 Commitment of Traders reports, these institutions flipped from being the primary suppressors of price to the most aggressive buyers on the planet. For decades, these banks used massive short positions to keep a lid on silver, but as of this window, they have officially switched sides. The scale of this orchestration becomes clear when you look at the price action. During the same 90-day window that the vaults were being emptied, the price of silver exploded from $30 per ounce to $79. This was not a random market move. This was a calculated repositioning by the architects of the financial system itself. If you want to understand how the world is changing, you have to stop listening to what the banks say and start watching where they move their physical assets. One bank in particular, JP Morgan, has led this charge, transitioning from a record-breaking manipulator to the owner of the largest private silver stockpile in human history. We are witnessing the death of the paper silver market and the birth of a new reality where only physical possession matters. To understand why the December drain is so catastrophic, we must pull back the curtain on the grandest illusion in modern finance, the paper silver market. For the average investor, buying silver often means clicking a button on a brokerage app or trading a futures contract. They believe they are participating in the silver market, but in reality, they are playing a game of musical chairs with digital promises. The global financial system has operated for decades on the assumption that only a tiny fraction of contract holders will ever ask for the physical metal. This is the definition of a fractional reserve system applied to commodities. As of late 2025, the mathematics of this illusion have reached a breaking point. According to official Comex positioning data, there are currently 18.3 paper contracts for every single ounce of registered physical silver held in the vaults. Think about that ratio for a moment. If just 6% of the people holding these paper claims decided to stand for delivery instead of settling for cash or rolling their contracts forward, the entire registered inventory of the New York vaults would be wiped out instantly. The system is not just leveraged, it is structurally incapable of meeting its obligations if a crisis of confidence occurs. The danger of this 18-to-1 ratio becomes apparent when we examine how silver is actually used. Unlike gold, which is primarily a monetary asset stored in bank vaults, silver is an essential industrial commodity. It is consumed in everything from high-end electronics to medical devices. When an industrial user in South Korea or a solar panel manufacturer in Vietnam buys a futures contract, they aren't looking for a quick speculative profit. They are looking for the raw material required to keep their factories running. When these industrial giants realize that the exchange is running on fumes, they stop playing the paper game and start demanding physical delivery at any cost. The divergence between paper and physical reality is what we call the decoupling. In a healthy market, the price of a paper contract and the price of a physical bar should be nearly identical. But in December 2025, we saw the paper market trading at $32, while physical dealers were demanding premiums that pushed the real price toward $40 or more. This spread is the market's way of telling you that the paper price is a lie. The 18-to-1 leverage worked as long as the vaults were full, but with nearly 80% of deliverable metal gone compared to 2021 levels, the illusion is shattering. We are moving toward a world where a paper promise of silver is worth exactly as much as the paper it is written on, zero. To understand the current silver crisis, one must understand the history of J.P. Morgan Chase and its relationship with precious metals. This is an institution that paid $920 million in fines to the Department of Justice and the CFTC between 2020 and 2021 for the illegal manipulation of the silver and gold markets. For nearly a decade, their trading desks were accused of using a technique called spoofing, placing massive sell orders they never intended to execute to drive prices down, only to buy back at a lower level. But a predator does not stop hunting because it was fined. It simply changes its strategy. The shift began quietly. While their public-facing analysts often downplayed silver as a volatile or secondary asset, the bank's own vault data told a different story. According to trade sources and precious metals tracking analysis, J.P. Morgan spent the last few years transitioning from the world's largest short seller to the world's largest physical accumulator. By the middle of 2025, it was reported that the bank had built a private stockpile of approximately 750 million ounces of silver. To put that number in perspective, that is more than 75% of the total global annual mine production. This pivot is the ultimate insider trade. For years, the bank used its massive balance sheet to keep silver prices artificially suppressed, creating a decade-long period of stagnant prices that discouraged new mining investment. While the rest of the world looked away, they filled their vaults in London, Singapore, and New York with metal purchased at a discount. By the time the December 2025 vault drain hit the news, J.P. Morgan was no longer on the hook for rising prices. Instead, they had positioned themselves to be the primary beneficiary of the very shortage they helped engineer. This is what we call the predator's pivot. According to the December 2024 CFTC Commitment of Traders report, commercial banks as a group flipped to a net long position for the first time in the history of the data series. This was the signal that the game had changed. The institutions that once profited from lower prices were now betting on a moonshot. When the largest bank in the United States decides to own 750 million ounces of a physical commodity, they aren't just making a trade. They are making a statement about the future of the monetary system. They have moved their wealth out of the digital ether and into the heaviest, most certain form of value they can find. While the vault drain in New York captured the headlines in December, the true beginning of the end for the silver paper market occurred 2 months earlier in London. On October 8, 2025, the London Bullion Market Association, or LBMA, experienced a systemic shock that most retail investors never even heard about. The government of India, driven by an urgent need to secure raw materials for its massive solar panel manufacturing initiative and strategic industrial reserves, placed an emergency order for 1,000 metric tons of silver. This represents roughly 32 million ounces for immediate physical delivery. Under normal market conditions, an order of this size would be absorbed with minor price fluctuations. However, the London market is the global hub for physical clearing, where real bars move between real vaults. When the Indian order hit the desks, the physical liquidity simply was not there. Within hours, the market seized up. The most telling indicator of this panic was the explosion in silver lease rates. Normally, it costs next to nothing to borrow silver because it is considered an abundant commodity, with lease rates typically hovering around 0.25%. But in the 48 hours following the Indian order, those rates skyrocketed to over 200%. This 200% spike was a mathematical scream of desperation. It meant that institutions with delivery obligations were so desperate to find physical metal that they were willing to pay 200 times the normal rate just to borrow it for a few days. They weren't fighting over paper contracts. They were fighting over actual bars of silver that had already been promised to multiple parties. This was the moment the world's central clearing hub for silver effectively froze, revealing that the physical cupboards were bare. To make matters worse, Metalor, one of the most prestigious precious metals refiners in Switzerland, issued an unprecedented statement shortly after the London freeze. They announced they would cease accepting new silver refining orders until January 2026. When a refinery that has survived world wars and global depressions says they cannot source enough raw material to operate, you are no longer dealing with a temporary market glitch. You are witnessing the first domino to fall in a global structural collapse. The London freeze proved that the physical supply chain was broken, and it set the stage for the massive New York vault drain that would follow just weeks later. As the Western market struggled with liquidity, the final blow to the global silver supply chain came from the East. On November 3, 2025, the Chinese government issued a directive that sent shockwaves through every industrial boardroom in the world. Beijing announced an indefinite ban on all silver exports. For decades, China had been a cornerstone of the global market, exporting over 5,000 metric tons of silver annually to satisfy Western industrial and investment demand. Overnight, 15% of the world's tradable silver supply was removed from the board. This move was not an act of economic aggression, it was an act of strategic survival. China's internal data revealed a terrifying reality. According to the Shanghai Futures Exchange inventory reports, domestic silver stocks had collapsed by 2/3 in a single year. In January 2024, those warehouses held over 1,200 metric tons. By November 2025, they had plummeted to less than 446 metric tons, the lowest level in over a decade. China realized that its own massive transition toward green energy, specifically its dominance in solar panel and electric vehicle manufacturing, required more silver than it could produce or import. The Eastern Fortress was being locked down. While Western banks like JP Morgan were accumulating metal for profit, China was accumulating metal for national security. They understood a fundamental truth that the West chose to ignore. You cannot build a high-tech economy on paper promises. You need the physical conductivity that only silver provides. By banning exports, China effectively told the rest of the world that if they wanted silver for their own green energy transitions, they would have to find it somewhere else, but the vaults in London and New York were already bleeding dry. This strategic hoarding created a massive price disconnect. In the Shanghai market, physical silver began trading at a significant premium over the New York Comex price. This arbitrage opportunity should have drawn metal from the west to the east, but there was a problem. There was no metal left to move. The depletion of Chinese inventories, combined with the export ban, created a vacuum in the global market. We are now in a situation where the world's largest manufacturer has stopped sharing its most critical industrial metal. The East has recognized the true value of silver as a strategic asset, leaving the West to choke on a mountain of paper derivatives that no longer represent reality. The crisis we are witnessing is not merely a result of financial speculation, it is driven by an insatiable and irreversible industrial hunger. Silver is no longer just a precious metal for jewelry or coins, it has become the indispensable oxygen of the modern technological era. According to the Silver Institute, the world is now grappling with its fifth consecutive year of a structural supply deficit. In 2025 alone, this shortfall is projected to reach approximately 117 million ounces. When you look at the cumulative deficit since 2021, we have already drained nearly 800 million ounces from global above-ground stocks, roughly equivalent to an entire year of global mine production. The primary engine behind this demand is the global green energy revolution. Solar photovoltaics, or PV technology, has moved from a secondary source of demand to a primary market driver. In 2014, solar accounted for only 11% of silver's industrial consumption. By 2024, that figure surged to 29%. Despite efforts in thrifting, reducing the amount of silver used in each individual cell, the sheer volume of global installations has overwhelmed those efficiency gains. In 2025, global solar installations are set to hit a new record high, ensuring that silver demand from this sector remains a permanent and growing fixture of the market. Parallel to the solar boom is the rapid electrification of the global automotive fleet. An internal combustion engine vehicle uses a relatively small amount of silver, but a battery electric vehicle, or BEV, requires 67 to 79% more. On average, each electric vehicle consumes between 25 and 50 grams of silver. This metal is critical for everything from battery management systems and power electronics to the massive expansion of charging infrastructure. The Silver Institute forecasts that by 2027, electric vehicles will overtake traditional engines as the primary source of automotive silver demand, accounting for over 59% of the sector by 2031. The problem for the market is that this industrial demand is fundamentally inelastic. A solar panel manufacturer cannot simply decide to use less silver or switch to a cheaper alternative when the price spikes. The electrical and thermal conductivity of silver is unparalleled. If they cannot source the physical metal, the production lines stop. This creates a price floor that didn't exist in previous decades. While retail investors might sell their coins when they need cash, industrial giants are forced to buy at any price to protect their multi-billion-dollar infrastructure projects. We are entering a new regime where silver is valued more for its utility in a data center or a Tesla than for its luster in a vault, and the supply side simply cannot keep up. In a healthy commodity market, the price for delivery in the future is typically higher than the price for delivery today. This is a state known as contango, which accounts for the costs of storage, insurance, and interest. However, by mid-December 2025, the silver market entered a state of extreme backwardation. This occurs when the spot price for immediate delivery is significantly higher than the price for future delivery. It is the financial equivalent of a red alert, signaling that the market is so desperate for physical metal right now that it is willing to forego all future premiums just to get its hands on a bar today. The scale of this breakdown was unprecedented. We witnessed a $3,000 spread per contract between the December 2025 and March 2026 deliveries. In a functioning market, this gap would be closed instantly by arbitrageurs buying the cheaper distant contract and selling the expensive near-term contract. But this arbitrage only works if you can actually deliver physical metal to settle the trade. The fact that the spread persisted for weeks proves that the arbitrageurs had no metal to move. The mechanism that links paper prices to physical reality has effectively snapped. Even more revealing was the inversion of the cash futures basis. Historically, the Comex futures price commands a small premium over the London spot price. However, in late 2025, this relationship inverted. Comex futures were trading at 60 cents below the London spot price for over 3 consecutive weeks. According to CME Group settlement data, this is the longest sustained inversion in the history of the exchange. It tells us that the global market has lost faith in the paper promises of the New York exchange. The market is screaming that a paper contract in New York is worth less than a real bar in London. This decoupling is the moment of truth for price discovery. For over a century, the Comex has been the world's benchmark for silver pricing. Mining companies, industrial manufacturers, and investment funds all use these quotes to value their businesses. But what happens when the benchmark no longer reflects the cost of the actual asset? If a manufacturer must pay $38 to secure silver in the physical market while the Comex screen says $32, the screen becomes an irrelevant piece of digital fiction. The broken mechanism of backwardation is proof that we are moving toward a tiered market, a cheap price for paper that you can never redeem, and a very expensive price for the metal you can actually hold. As the divide between the digital price and physical reality widens, we are witnessing one of the most significant wealth transfers in the history of the commodities market. This is a silent migration of value from those who hold promises to those who hold properties. For decades, the financial establishment encouraged investors to use exchange-traded funds, or ETFs, as a convenient way to gain exposure to silver. The most prominent among these is the iShares Silver Trust, known by its ticker SLV. Millions of Americans have these shares in their retirement accounts, believing they represent a direct claim on silver bullion sitting safely in a vault. However, the fine print tells a different story. If you examine the SLV prospectus, particularly the amendments updated during periods of market stress, the language is chilling. It states that in circumstances where physical metal cannot be sourced at a reasonable price, the sponsor has the authority to suspend the creation of new shares or even settle redemptions in cash rather than metal. This means that at the exact moment a physical shortage sends prices into the stratosphere, your ETF shares might be locked into the artificial suppressed paper price. You would be paid out in depreciating dollars while the physical silver you thought you owned remains out of reach. This risk is even more acute for those holding unallocated accounts at major banks. An unallocated account is essentially an IOU. You are a general creditor of the bank, and the bank does not have a specific bar with your name on it. It is a system built on the assumption that everyone will not show up at the same time to claim their assets. It is like a gym that sells 10,000 memberships, but only has equipment for 200 people. In December 2025, the metaphorical gym doors were crowded, and the staff began locking the gates. Those with unallocated claims are finding themselves at the back of a very long line, while institutions like JP Morgan move their own physical bars to the front. The winners in this scenario are the individuals and institutions that prioritized clear title and physical possession. Whether it is sovereign coins like American Silver Eagles or segregated, allocated bars in private vaults, these owners are not dependent on the solvency of a clearinghouse or the honesty of a bank. They own an asset with zero counterparty risk. As the registered inventory on the Comex drops toward zero, the premium for being a physical owner is no longer just a few dollars. It is the difference between having your wealth protected or having it vaporized in a brokerage default. The great wealth transfer of 2025 is a harsh lesson in the difference between the price of an asset and the value of owning it. As we move into the final days of 2025, the financial world is bracing for what could be the most critical delivery month in the history of the silver market, January 2026. According to the latest CME Group positioning data, the open interest for the January silver contract has reached levels never before seen for a traditionally minor delivery month. In the past, January was a quiet period where traders simply rolled their positions into the more active March or May contracts, but this year is different. The volume of contracts standing for delivery is now threatening to collide head-on with the depleted inventories we discussed earlier. The math for January is brutal and undeniable. With Comex registered inventory sitting at approximately 33 million ounces following the December drain, the system is facing a massive shortfall. The open interest represents claims on hundreds of millions of ounces. If even a modest 10% of these contract holders demand physical metal, the exchange will be forced into a corner. We are already seeing the first signs of this stress in the delivery completion rates. In December, only about 7% of delivery notices resulted in actual physical metal transfers. The rest were settled through exchange for physical maneuvers or cash settlements. In January, the pressure will only intensify as industrial users, desperate for raw material after the Chinese export ban, use the futures market as their primary source of supply. Major financial institutions are rapidly revising their forecasts to reflect this new reality. Analysts at UBS have recently raised their silver price target to $60 per ounce for mid-2026, noting that a spike to $65 is highly possible. Bank of America is even more bullish, projecting a move towards $65 driven by structural deficits and the massive demand from the solar sector. Some aggressive models from boutique commodity firms even suggest that if a true liquidity squeeze occurs in January, where physical premiums completely decouple from paper prices, we could see a vertical move toward $80 or even $100 per ounce. The trigger for this moonshot will likely be a high-profile delivery failure. Imagine a scenario where a major electronics manufacturer or a sovereign entity submits a delivery notice for 5 million ounces and is told the metal is simply not available. In the tight-knit world of global commodity trading, that news would travel at the speed of light. The result would be a mad scramble for any remaining physical bars, sending spot prices into a parabolic arc while the paper market faces an existential crisis. January 2026 is not just another month on the calendar. It is the moment when the decades-long game of fractional reserve silver trading finally meets its day of reckoning. The events of late 2025 have provided a masterclass in how the global financial system truly functions when pushed to its physical limits. The historic 47.6 million ounce drain from the New York vaults was not an isolated incident or a temporary market glitch. It was the definitive signal that the era of paper price suppression is over. As of December 28, 2025, the live spot price of silver has surged to $79.39 per ounce, nearly tripling its value from the start of the year. This explosive move confirms that the market has finally accepted the reality of a fifth consecutive year of structural supply deficits. The most important lesson for every investor is the behavior of the institutional giants. While the public was told silver was a dead asset, JP Morgan was quietly accumulating a physical stockpile estimated at 750 million ounces. They didn't just buy the dip. They absorbed 20 to 24% of all new global mine production. They understood that in a world of accelerating green energy demand and tightening export controls from the East, physical metal is the only true collateral. China's decision to implement strict export licensing starting January 1st, 2026, is the final confirmation. The East is locking down its resources, leaving the West to reconcile hundreds of millions of paper claims against vaults that are increasingly empty. As we head into January 2026, the question is no longer whether silver will rise, but how you have positioned your own wealth. If you hold your silver through unallocated bank accounts or paper-heavy ETFs, you are essentially a general creditor in a system that is running out of inventory. The wealth transfer currently underway is moving from the digital to the physical. To protect yourself, you must follow the lead of the smart money. Prioritize physical possession, secure allocated storage with clear title, and understand that in a systemic shortage, a promise to deliver is not the same as the asset itself. The silver heist was not committed by a thief in the night. It was an open orchestration by the largest financial institutions to secure the world's most critical industrial and monetary metal before the rest of the world realized it was gone. Those 47.6 million ounces that vanished in 4 days were the final warning. The physical market has spoken, and the paper illusion has shattered. Now that you know how the game is played, the choice to protect your future is in your hands. Own the metal or own the risk.